Yeah. So Jim asks, John, I came late to the presentation, so I apologize if you happen to touch on this. What are your thoughts on the early retirement, early retire extreme movement as a whole? And what are your thoughts on the reliance on low fee index funds such as Vanguard? Uh,
Yeah,
yeah, go
is
ahead.
that it? Okay, yeah, as far as Vanguard goes, that if I was an individual investor and I had no other place to invest, that would be the place I put all my money. Vanguard, highly reputable. Uh, they do things extremely well. They have about the lowest cost in every category of exchange traded fund or mutual fund. And I would actually encourage you to do exchange traded funds rather than mutual funds, because I think over time they have better, they're more efficient with what they charge you for fees. So I like broad diversification. I mean, if I had only one thing I could invest in, the Vanguard Total Stock Market Exchange Traded Fund, I mean, that's what I would put it in, because you're going to get broad market exposure. It's very inexpensive to own. Vanguard's an excellent, stable company. So from that perspective, that's good. As far as the extreme retirement movement, not at all opposed to it. I've met some of those guys, and a lot of them are not living what I would call living. I mean, they're they're living at a much lower lifestyle than I would want to live at. So I would at least wouldn't discourage you from that. I just have you really think about what level do you want to subsist at. I like air conditioning. I like steak. So I'm not opposed to that extreme thing. But the other side of it, though, I like the aspect of reducing their spending. And so for people that are inclined to go that way, though, I'd encourage you, again, keep the day job, keep working. Don't spend a lot. If you can live in a tiny house or live in a smaller house, or just reduce your overall footprint, then that's going to be more money in your pocket. And that, again, the big problem I have with the early retirement, the extreme early retirement people, for those of you that don't know what we're talking about, there are people that, hey, they want to retire at 30 years old. And again, they're retiring, but they're not so much retiring as they're subsisting. Are they able to pick up and fly to France when they want to? Are they able to, just a simple thing, drive across town and see their kid play a soccer game or something? Well, if they're scrimping that much, and if they don't have the income, they don't. The way you have that freedom is to earn the income and invest it. I'm not retired, not because I have to work or because I need to work. I'm not retired at age 55 because I like to work. I'm working right now, right? I'm in my office. I'm taking a break from my normal stuff to be talking with Josiah and the rest of you, but I'm working. This is where I work. I love what I do. I get up every day excited to do what I do. I only take on clients that I love to work with. I don't take on people because I need their money. I take on people I think I can help. And because I can help them, and because they're smart, intelligent people, I learn as much from them as they learn from me. And it's just, why would I want to retire? I mean, it would make no sense to me. I'm having too much fun to it. I wish I knew how to do this when I was 20, because, I'd have been 30 years ahead of it. So I personally don't ever want to retire. And I would encourage people to find what you love to do. Just learn how to make an income on it. It's great. I think that answered the question.
Yes. Well, he had a little add-on to there. He says there are alternative ERA or ERE, methods involving real estate, dividend stocks, etc. as well, but the low-cost index fund is the most commonly discussed in these circles. I don't know what he's talking about. Do you?
Maybe. And what I'd say is, for that person, they're more advanced. Go check out that video I did at Jack Spirko's place. It's on YouTube. I cover some of that stuff. What I'm a believer in, and the way I made my wealth, is I was able to invest in appreciating assets. It's sometimes appreciating assets are real estate, so it makes sense to be in things like REITs, or to own commercial real estate or rental real estate or whatever. That was a great time, particularly between 1998 and 2007. Real estate was a great investment. In 2009, it wasn't such a great investment. It really didn't become a good investment until probably 2012 again. So all of these things, if you read the Old Testament, you've seen the proverb where it says there's a time to buy and a time to sell. There's a time for all things. Like when you plant your garden or when you do things with permaculture. If you live in Salt Lake City like I do, you don't plant tomato plants out in your yard in December because they wouldn't grow. Right? Now, tomato plants are great to grow in June, but not in December. Real estates, REITs, other type of income type assets at certain periods of time in cycles of the economy, they're great to invest in. A lot of people in the permaculture kind of thing like gold, and gold is a great thing to invest in when it's going up. But from 2011 till just 5 months ago, gold was going down. And it didn't matter how much intrinsic wealth there was, the asset was going down. And so I'd encourage people to focus on understanding where we're at in the business cycle and what's going up, what's going down, rather than just saying, I should only invest in index funds. The industry wants you to only invest in index funds, number one, because it's easy for them, because they can put you into one fund. And then number two, because over time that does work. Investing in the United States stock market over 30 years works out, but it may not work out over a 10-year period. And that's why I would encourage people to be cautious. Check out that video I made where I talk about appreciating assets.
So Jim's question, the main reason I brought it up is because it really resonated with me. And I'll just share my quick story. It was, I guess, about 5 years, maybe 7 years ago, a guy named Paul Wheaton, which a lot of people here know, told me to read the book, Early Retirement Extreme. So I picked up this book and I read it, and I didn't really enjoy the book, but a big takeaway for me from that book was the whole reducing your lifestyle, and it had a huge effect on me. So what I did was, the first thing I did was me and my wife just looked at all the stuff we had and decided we didn't need just stuff. We need to reduce down to what just our needs are. And then, so we went through everything. I mean, our clothes, we just had enough clothes. We had our winter clothes and our summer clothes and enough for a week. And then we just washed our clothes once a week. We did our silverware. We brought it down. We said, okay, we're probably not going to have more than 3 people visiting us at a time. So we'll reduce it down to 5 forks, 5 knives, 5 spoons, and 5 plates, everything. And we reduced everything. And it ended up being huge for us because it made us realize all the stuff we don't need. And another thing that we decided to do was, anytime we went to a store, we didn't buy anything unless we went to the store to get that item. And that was a huge, and it took a lot of self-control. It took the partnership to really make that happen, in that if I went to the store and saw something I wanted, she would be, okay, we didn't come for that. And so we don't. And that was another huge thing for me. The next thing I did was I reduced the living space. So by reducing the living space, we ended up buying an RV and just said, we're going to live off this RV. And by reducing that living space, it made us get rid of a lot of stuff and made us realize we didn't need even more. There was even more things we didn't need, and we got rid of those. And because we limited our space, we were limited on what we could buy. So we didn't buy things that wouldn't fit in our living space. And that helped us greatly reduce our costs. And what ended up happening is we found we started having a lot more money, and we could use that money for things like going out and enjoying ourselves, or saving and putting money into investments, which were, for us, we ended up, we're still in the process of this, is getting small pieces of property. We live in an RV, so we got these small pieces of property, 3-5 acres. And we build our farms on there, our permaculture food forest farms. And then we travel. So we can go to each one of these properties that we love going to anytime we want to go somewhere new. And then in the meantime, we rent out that property to other people that RV. So that was another way of generating revenue. And it provided us with a food forest, which will hopefully be much more productive in the future because it's perennials. It takes time to grow. But we have food there as well, so that takes care of our needs. We looked at our needs and saw what we could reproduce on our own without having to go and buy it. So the early retirement extreme, while I don't follow it, a lot of the practices really helped me a lot. And it got me to the point where I could look at this job. I was making the same amount of money, but I was gaining a lot more money, a lot more wealth. And it gave me the opportunity to quit that job eventually.
Right.
Because I was living just fine off of so much less. I could do a job that paid a lot less, like starting my own business, that paid a lot less, so I could focus on growing that and not doing this 80-hour a week job that was driving me nuts. Because I was at the point where I was making enough money where I could handle everything I needed because my needs reduced a great deal.
Yeah, like I say, the reduction of the lifestyle or the living expenses, I think, is great. But I guess what I'm opposed to is the part about the retirement is as though work is a bad thing. And I think work is a great thing. I think it's one of the reasons we're here, right? What if Steve Jobs retired, right? I wouldn't have an iPhone. If Elon Musk made a gazillion dollars off of eBay or PayPal or something, right? If he retired, well, we wouldn't have Tesla. We wouldn't have SpaceX. I'm all about, and actually I see a question here you might be getting to. This will taper into it. I became what I would consider financially independent when I was about 48 years old. And I had about 15 years of living expenses saved up, right? And saved up is relative. I mean, that was in the stock market. That was in real estate. That was my net worth was 15 years of living expenses. And so I was still working a corporate job that I didn't like, living in a state I didn't want to be in, all that kind of stuff. And I said, well, I can live the next 15 years and not have to have a job. Now, I wouldn't live well. I mean, it wouldn't be like I'd be eating caviar every day, but I could easily maintain my living expenses for the next 15 years. So that's at age 48. I talk about being a late blooming entrepreneur. I didn't start my first business until I was about 52. But I started really thinking about it when I was 48. I said, okay, I'm not going to retire, but I'm going to quit the day job that I don't like, and I'm going to quit living in the city I don't like living in, and I'm going to move more towards my lifestyle of freedom. And what can I do? What are my talents and abilities that I can create products and services that generate income because people want to buy them? And so, had I just quit and retired, I would have had to figure out how to make my 15 years of wealth straight, because that would have been like 63 years old or something, right? I still have a lot of years left to go. Well, what I did was I started, I quit my job, I formed my business, and I invested in myself. And so now I'm in a position where I have, 25 or 30 years of income saved up, right? So rather than retiring, I built my wealth by gaining more freedom, by starting a business that I love more.
Yeah, and that's what it allowed me to do. That was the big
right.
takeaway. Or what I really gained from it was that I didn't have to work this job I didn't like. I'm still going to work. I'm probably never going to retire because I wanted to do what I love doing, and that's what I'm doing. I think that's
right. So I didn't buy a bigger house. I didn't buy a bigger car. Right? My teenage kids are still like, Dad, how about like a BMW or a Corvette or something? I'm like, hey, a Subaru, it's fine for me, right? A minivan, I'm happy with that. That's why I have the wealth I have and why I can kind of be retired or do what I love to do, because I don't waste it. I buy the things that I need and I make them work. And that's the kind of thing too that when I talk about that or other people talk about things, don't focus on the negative part of like, oh, he said 30 years for solar panels, he's wrong. But focus on what I said is right. Like, don't spend so much on your car. We can always look at things that we don't like and want to criticize, but our lives are going to be better if we focus on the part that we can know makes sense. If you can get solar panels and pay them off in a year and it's a great investment, then great, do it. Don't worry about that. Don't spend that extra $4 at Starbucks. I mean, that's where you want to work. That's where that person needs to focus on.
Yeah. And I like solar panels, and I hope that they continue to advance and get us more energy where they become more cost effective. I have solar panels on the RV, but I don't have them on the house because it's a huge investment, and it's cheaper for me now to just get the electricity from the electrical company. It's just how it is. I get the reasons if you have moral dilemmas, and that's a big moral dilemma in your life you want to answer?
Totally different subject, right? I mean, and that gets back to your ethics and how are you able to choose to do that because you have money to buy the panels. So absolutely. I mean, people need to make some of those decisions on an ethical basis. I do a lot of things that don't make any financial sense. I tithe. I pay a tithing because of my beliefs. Makes
Right.
absolutely no financial sense, but it's part of my ethics. And I'm only able to do that because I make money. If I didn't have a profit, I couldn't pay a tithe. So,
All right, next question. Let's see here. Carl asks, any thoughts on auto repair industry changes, meaning car sharing, electrical cars, automated driving? Is this a good business to stay in or to get into?
I think the repair and the maintenance side is still a good business. There are definitely shifts in that economy. I mean, you can just go out and look at the performance of some of the rental car companies like Hertz and Avis. Several of those are merged now too, and I don't really follow them, so I don't know which ones are which. But last time I looked at, I believe Enterprise, they were down significantly in the last just year alone because of the impact that things like Uber are having on them. Business guy going into flying into LA for one day, he's not going to rent a car now. In the old days, you rent a car because it wasn't convenient to get a taxi. Nowadays, you know what you're going to pay. You know you're going to get a driver. You know what kind of car he's going to be. You don't have to worry about getting lost. I mean, it's so much easier just to do Uber. So that's definitely affecting certain things. I mentioned I own a Subaru. It has the driver. It's a 2016 model. It has the driver assist on it, which is like just a supercharged cruise control, where it slows down, it speeds up, it nudges you if you're going out of your lane, and it's not totally autonomous, but it is. I mean, I've driven for 4 hours on the interstate, and barely touched anything because it just drove me. So I think those are making big changes down the road. If they make us safer drivers, it's going to have an impact on insurance companies, just as airbags have had an impact on driver safety in terms of the airbags don't make us wreck any less. But if you look at fatalities, they're about 30,000 now, 30,000 a year car fatalities. When I was a kid, I remember seeing the statistics, something like 57,000 people a year were dying in the 1970s in car accidents. So all those things definitely have impacts. But if you're skilled, certainly I know auto mechanics, auto body guys, car mechanics, making nice six-figure incomes now. And in fact, I know a couple of guys that paint cars. All they do is paint cars. They don't own the shop. They're just like the hourly worker that paints cars, but they're really, really good at what they do, and they get a premium for it. They're pulling in $100,000. I'd encourage you, if you have a talent, if you're mechanical like that, do that, because particularly the services are not jobs that we can export. So yeah, we can bring cars in cheaper. We can bring in washing machines. We can bring in iPhones and things that are made cheaper in foreign countries. Automation is going to make that stuff even more cheaper, even when it's made in the U.S. But when it comes to repairing or when it comes to services, that's hard to outsource. So, the people that are providing personal services are not that they're going to be safe forever, but they do have a leg up on people that are in straight manufacturing. So I think automobiles are still safe for some time. And then, as always, you make that better. If you do see a trend coming in, hey, learn to repair robotics, or take that to the next level, because the skill you have as a skilled mechanic is never going to go away. People talk about the hype over 3D printers. I think 3D printers are going to change a lot of things. They've already changed manufacturing, particularly in prototyping. But the bottom line is Leonardo da Vinci is always going to be better with a 3D printer than I am, right? Because I don't have any talent. And so if you have a talent for something like auto mechanics, do it, man. Go make money and figure out how to make it better.
Yeah, the next topic I kind of wanted to cover is age different, like different generations. So let's say I'm between 25 and 35, and I've got $10,000 saved up. What do you think is going to be my best option, and what to do with that money?
Yeah, let me cough here. I apologize. So for people that, okay, I'm an investment license-wise, I'm an investment advisor. I really don't advise people in investing. I trade stocks. That's why I'm a money manager. That's what I do for a living. So I'm a big proponent of being invested in the stock market. But having said that, I'm only a big proponent for people that have enough money to make it work. And if I can just draw a quick analogy, if you're going to go build a shed in your backyard and you have a regular old claw hammer, yeah, you can probably build that shed, fairly easily. If you have a nail gun, you're going to be able to knock it out in no time. But if all you have is a tack hammer, you're never going to get that shed built. And so when it comes to investing, like in things like the stock market or real estate or whatever, despite all the things you hear about investing in Forex and options and getting rich quick overnight, or buying real estate and flipping it with no money down, I have met very, 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 very few people that have done that. Okay, not that it can't be done, but very, very few. So to the people that have no money to put down or very limited money, I would say you're trying to build a shed with a tack hammer instead of a claw hammer or a nail gun. So basically, I think if you don't have more than $50,000, $100,000, you have the tack hammer. You just don't have enough to make it worthwhile. Because if you have $10,000 and you get a 10% return on it, well, you made $1,000. If you're 35 years old, there's probably easier ways to make $1,000, right? I mean, go to school, get a better education, get a raise, a part-time job, start your own business. There are just other ways to do it. So for someone that's fairly young, and regardless of how much money they have, if they have anything less than 50 or 100,000, they need to be, I would think, number one, saving so they do have more someday. But number two, investing in themselves, figuring out how they can earn more money and at the same time do what we talked about, reducing their living expenses so that they don't get stuck in the trap of, middle class trap of owning a McMansion that they can't afford, driving a car to a job that they hate, commuting for 3 hours, in a car that gets lousy gas mileage that's costing them $400 a month payment. I mean, these are all the mistakes that people make. And the best thing that someone in that age group can do with a $10,000 is not fall into that trap, and don't think they're going to turn that 10,000. I heard somebody the other day, again, I was at a conference, heard somebody saying, well, if you invested $10,000 and they rattled off the stocks in Facebook or in Google or in this or that, how many millions you have today. Yeah, but they did. That's a historical survival bias where they forget all the stocks that failed. Yeah, Facebook did good. Do you remember MySpace? MySpace was bought by Rupert Murdoch for, I don't know, 520 million or something. Rupert Murdoch's a smart guy. He's no dummy, smarter than any of us. And he bet on the wrong horse. So if you have $10,000, if you're 35 or younger, you should probably be investing it. You shouldn't be putting it in this. I mean, I'm not opposed to putting it in the stock market if it's part of your 401k plan where, it's matched by your employer and you don't have anything else to do with it. That's fine. That's your long-term retirement savings. But when it comes down to that initial money you have, you should be figuring out ways to invest in yourself. How do I get a better job? How do I move someplace where it's cheaper? Again, that analogy about, you live in New York City and make $100,000, you're going broke. Maybe you should move to Texas or North Carolina or North Dakota, make 25% less, but you'll be putting more money in your pocket. Take that $10,000 and go move.
I wholeheartedly agree. Yeah, excellent. And so now that brings me to the next group, which would be people about to retire or that have retired and are getting a pension, or maybe they've gotten a lump sum out of their 401k, something like that, where they have a decent amount, $50,000, $120,000 to invest, and they want to live off of that investment. What would you recommend to those?
Yeah, and we live, Josiah, we live in some real challenging times right now. We're at a real inflection point of where not only the U.S. economy but the global economy. It's what I call a tug of war in between inflationary pressures and deflationary pressures. And the deflationary pressures are coming from the things like automation, where the cost of products are coming out. We either farm something out and make it overseas where it costs less money because the labor's cheaper, or technology just makes it less expensive. The reason that oil today is under $43 a barrel, and In 2008, it was $145 a barrel. The reason isn't that we have more oil today. It's just that it's cheaper to get the oil that we have. The reserves have only expanded because they become attainable. What was financially unattainable is now attainable because of automation. Horizontal drilling, fracking, things like that have brought the cost of oil down. That's very deflationary. On the other side of things, on the inflation side, the people that like to buy gold and silver talk about is the debasement of the economy, or the debasement of our currency. Totally true. And it's that tug of war between those two forces. On the one hand, the government is devaluing our money, and on the other hand, things like technology and globalization are creating deflationary pressures, which are making our money worth more. So it's that tug of war, and right now neither side has won. And so we see ourselves in an environment. I bring all that up because we're right now, the 10-year Treasury is at like 1.57%. Now, to put that in perspective for younger people, when Bill Clinton was president, say in the 1990s, it was at about 6% for the 10-year Treasury. So if you were a middle-class person that busted your butt and worked hard and did all the things we talked about to skimp and save, and you live in the same house, and you started your own small business, and you built up a clientele, and after 40 years of that, you saved up $1 million, or maybe you sold your business and you made $1 million. Well, you could put that risk-free into 10-year treasuries and be getting a $60,000 a year income. That's at a time when the average household income was about $35,000. So you were like almost twice as much as the average guy for not doing anything at zero risk investment. Fast forward to today, if you had $1 million at 1.5%, you're making $1,500 or $15,000. Middle class income is $50,000. So it takes $50,000 to live, and your $1 million only generating $15,000. It's that tug of war between deflation, inflation, globalization. I don't know how it's going to get resolved yet, and that's why I move forward very cautiously, and I never put all my eggs in one basket. I invest in multiple technologies and in multiple things, multiple currencies, multiple things like precious metals and stuff. So for someone that's retired now and they only have, say, $100,000, $200,000, it's just not going to go anywhere near where it went 20 years ago. And again, even you really need $2 million now or more to not live half as good as you would have with $1 million when Bill Clinton was president. So to the older people, I'd encourage them to again, not, if they can help it, not retire, if they can get that second job, if they can start their own small business, whatever they can do to keep an income stream up, that's very advisable, because I don't see the interest rates necessarily rapidly increasing in the next 5 to 10 years. I mean, we don't know. We just don't know how it's going to work with the central banks, but it's extremely, extremely difficult to find investment income at low risk right now. And so what that means is these people have to take additional risk. I don't hear anybody telling me now that they went out and bought Procter & Gamble stock because they think it has good growth prospects. They tell me they bought Procter & Gamble stock because it pays a 3% dividend, and they're not getting that in the bank or anywhere else. The problem with that is it's bid the price up so much of things like Procter & Gamble stock that they're really unrealistic. In many cases, they're 20 times or more valuation, 20 times price to earnings ratios. That just doesn't make sense for these non-growth stocks. And so for older people, I tell them to be very, very cautious. Be very, very cautious about putting all their money in the stock market, because as people saw in 2008, as they saw in 2000, there can always be a serious correction. And in fact, a 20 to 25% correction is healthy. It happens every 5 to 8 years. We haven't had one. We haven't seen anything like that since 2008. And we're well overdue, which probability-wise doesn't mean it's going to happen. But just like people pouted into real estate in 2008, they thought real estate prices could never go down. Well, a lot of people think that stock prices can never go down, and they're trying to get a dividend yield and way overpaying for that. So I would encourage people to be cautious, be patient, let things kind of taper out. Mark Twain, who went bankrupt multiple times, he said you should be more concerned with the return of your principal than the return on your principal. And so that's what I would encourage people. Instead of trying to go out and make an extra 5% on their $150,000, they should be really concerned about just keeping their $150,000. Right now, general inflation is very low. I know the government manipulates the statistics and you can't always believe everything, but outside of really things like healthcare and education, for the most part, inflation is pretty much tamed. And some people are better off just putting their money in an FDIC insured bank account and leaving it there, just riding it out until the next downturn. Because there's always a downturn in the business cycle, and it's a whole lot easier to buy into something when everybody's panicking and fearful and the market's already dropped 30% than to buy right now when we're 1% off of the all-time record high. And that's a big risk for somebody that can't afford to lose their money.
Yeah. All right, next question is from Josh, and it has to do with prioritizing. So he has $6,000 in credit card debt, and he's saving about 10% of his finances and paying off the credit card as fast as he can at about 20% of his income. And he's wondering if he should continue to do this or switch to saving as much as possible until he gets to that 90-day emergency fund and then return to paying off cards.
He does. I can't do the math in my head there, but he doesn't tell us how much he's making, does he? He must be making
no
$40,000 or something, I'm guessing. $6,000 isn't a huge drain on him, as far as debt to be carrying. It's not the end of the world. But at the same time, he's probably paying 18% interest to carry that $6,000. So I think he's probably better off at least getting up to some kind of emergency fund where he can handle at least a little bit of a catastrophe, a couple $1,000s, in an emergency fund, and then start attacking that debt full force and getting rid of that $6,000. And it's not that much money. He should be able to wipe that off. The crucial part about having the emergency fund is, like we talked about in the presentation, if you don't have enough money to pay for your transmission, when it blows out, and something's always going to happen. It's going to be your transmission, or it's going to be, the shingles are going to blow off your roof, or you're going to fall down and break your arm and get laid off or whatever. If you can't make it through those emergency times, then you go to the credit card and you end up racking real quick $5,000, $10,000, $20,000 of debt. And so it's crucial to have that emergency fund. But when you're climbing out of that hole, he really wants to get rid of that $6,000 debt, because all it's doing is draining his income. He's paying 18% on that.
Yeah. I would say from personal experience, because I paid off all of my debt, it was definitely much more encouraging and, bless you, it was much more encouraging and motivational for me to pay off debt first and then start saving for the 90-day rainy day fund. But I felt much more secure once I had the 90-day. So that's just my personal experience with it, but great advice.
Yeah. It's always good to have $1,000 or $2,000 in cash, because virtually anything that happens to you it's going to cost you $1,000. I mean, right? You go to an emergency room, you take your car to get repaired. I mean, whatever it is, they're going to hit you up with $1,000. And if you don't have that in cash, it goes on the credit card, and then you're just behind the 8 ball.
Yeah. The next question is from Andrew, and if it's already been answered in the last one I presented with you, let me know. But he asks, where could he go for advice on where to put instant millionaire money from inheritance, like $100,000 in cash, after he's already got his house paid off and everything. It's just cash he has. Where would he go for advice?
It's really the financial industry is one of the few places where you don't necessarily get what you pay for. You can spend in most places. The higher money or the more money you spend on something, the better quality you get. I don't think that's necessarily the case in the financial industry. That's what prompted me to start my own company, because I saw a niche that I thought was very, just by providing it well, it was just by providing good service, you'd stand head and shoulders above other people, and it would be easy to attract clients. So I'd tell him to definitely look for some professional help. It's very difficult. He probably is not going to find it at a standard brand name kind of, I don't want to throw out any names, but like a corner store brand name investment advisory service, because generally those guys are going to have less money than him and less knowledge and information. They're salesmen, they're relationship salesmen. So he's going to have to do his homework, because, even at that level, the people that can afford to go into, the quote hedge funds, they're really people with $5 to $10 million. And even those, half of them are really loud. More than half of them are really lousy performers. So I encourage him to do his homework, talk to people, make sure that whoever he's investing with or getting his information from has more knowledge than he does and sounds like they make sense. If someone is promising you or even alluding to the fact that they can provide you with double-digit returns in this environment we're in, and I always hear 20%. 20% is the magic number. If someone's telling you they can provide you 10, 15, 20% returns, or it's likely or it's easy, then close your wallet and go to someone else. Because again, we're right now, a risk-free investment is 1.5% in a 10-year treasury. 1.5. So if someone can really generate 20% consistently, it would take no amount of time to be turning billions of dollars into trillions of dollars. And if you go out and look at any of the investment bankers, go look at their stock, go read their statements, they're not making that kind of money. So if those brilliant guys aren't doing it, the chance of you finding some guy on, in your town that's going to be able to help you to do it is slim to none. So you're again, that Mark Twain quote of be more concerned about getting return on your principal, or return of your principal, than return on your principal is wise. Having said that, though, there are you want to use diversification, you should definitely go out and look at that video I did on YouTube at Jack Spirko's place last year. That's in the show notes. I talk about appreciating assets there, and the important point of that is that when you've paid off the house, when you have that money to invest, you want to have broad diversification, but you don't want to have just simple diversification where you say, I'm going to put this in 10 asset classes just because, well, gold may be falling apart right now. And as it did from 2011 until just recently. And you say, well, how would I know that gold's falling apart? Well, you just look at it. You look at a chart of gold and you see that it's declining. And until it starts to tick back up, you don't want to, it's called catching a falling knife. You don't want to invest in a depreciating asset. Real estate was a great asset to invest in at about 2010, after everything else went bankrupt and all the distressed properties it was kind of known what their value was. That was a great time to go in and buy real estate. But buying real estate between 2005 and 2007, you're getting in at the top of the market. It made no sense to be diversified in real estate in that period because real estate was overpriced. So look for diversification, look for assets that are appreciating. It's really, really hard to find a financial advisor that you can trust. I'll just leave it at that. I saw a survey the other day that said that something like 80% of investment advisors felt that the number one service that they offered their clients was to basically reassure them and to keep them from basically selling at the bottom. It was kind of a buy and hold. They were saying the best thing they can do for their clients is to hold their hand and to make sure that they don't sell when the market's at its lowest point. When you ask clients what they wanted from their investment advisor, they just wanted good investment to help them grow their investments. I mean, they didn't want that hand holding. They wanted someone to help them make money. And so I think that what you're going to find in the investment industry is a lot of people are there to hold your hand, but they're not necessarily going to make you money.
What do you think about today's real estate market in terms of value?
I think for the most part, most markets, it's back to being overvalued. The thing that has really driven real estate has been overseas investing. So you go to Miami or you go to South Florida, a lot of money from South America has come into that real estate. You go to the West Coast, whether it's the U.S. or even up into Vancouver, a lot of that real estate has been driven by Chinese investors, Asian investors. So there's a point now where I think the only thing that's justifying the really high real estate prices is the fact that rent is so incredibly high. And as a percentage of income, I think the rent is the highest it's ever been. The big reason for that is kind of like cash for clunkers. If you remember back in 2009, they offered the cash for clunkers, turn in your old car and get $4,000 off on a new one. Well, it took all the used cars out of the market. So all the poor guys that are buying used cars, now they got priced out of the used car market. The same thing happened after the financial crisis with real estate in 2008, where these big investment firms like BlackRock came in and bought up all the distressed real estate in the form of REITs and these private investment trusts. And rather than letting individuals go out and buy a house at a discount, these big Wall Street firms bought it. They're renting those out, and it's just like the used car market skyrocketed. Well, now rent is skyrocketing, and so I'm very concerned. I know where I live in the Salt Lake suburb that I live in. It was in total the little community was in total bankruptcy in 2010. I mean, literally, people had come here, bought houses to flip. They bought houses one they couldn't afford, and then they bought a second house because they thought they were going to sell it and make money so they could put the money on the first house. And everything fell apart in 2009. They were all bankrupt by 2010, and so they didn't start building again until about 2013. But now they're crazy building again, and it's hard to find good labor. Hard to find somebody to do work because there's so many people are employed in the building trades again. So I would just be really cautious of it. I know in a lot of markets the value hasn't reached the highs of 2007, but boy, we're at a point where if interest rates start to marginally go up, it's going to have a really big impact on the price of real estate. You go back to the first house I bought was in 1990. I had a GI loan, 9.5% interest rate. You didn't see many people buying $400,000 houses in those days because 9.5% of $400,000 is a big investment, a big interest payment. And so it's only that people can afford these McMansions because interest rates have come down to 2% and 3%.
Right, and the banks would allow it. Like I think at least 20 years ago, a bank was a lot less likely to loan someone money than they are.
Oh, absolutely. Yes, I'm concerned about real estate. I'm less concerned about residential real estate, though, than I am about things like retail real estate. I don't know how Sears and Roebuck stays in business. Barnes and Noble, those kind of stores, a lot of the malls and the anchor, the big department anchor stores, J.C. Penney's and malls. I think they've got some hard times ahead. And then as we see more of this automation and people telecommuting, people doing different types of jobs, I think that's going to take away from even things like office space. And so I'd be more concerned about retail and commercial real estate than residential real estate at this point. But I do think we're probably back in another bubble. And again, if interest rates go to, it wasn't that long ago, interest rates were 6% on a home mortgage. That's going to have a significant impact on people's monthly payments. They're not going to be able to afford these McMansions.
What do you think, or what advice would you give to someone that's just looking to get property?
Well, most people are not going to like my answer, but unless they have cash, I don't think they should do it if it's just property. I mean, I think there's for people that want to farm, whether it's the spin farming models or different things, there's plenty of land out there. If you, and not that you're going to make a big income on it or anything, but if you at least want to go out and try it out, I'd borrow or rent, I think, before I bought at this point. But for people that do have the money, I even look in Josiah, where you and I live in the Rocky Mountain states. I mean, you look what it costs to buy an acre of even wasteland.
$3,000-$5,000.
Yeah, I don't think you can find something in Utah for under 10, and that's not even with water. I mean, you're going to spend probably $10,000 an acre to get a really inferior piece of land, and that's really high priced for the bang for the buck is really hard to justify right now. So I'd be cautious with that. Again, though, if it's like we talked about with stacking functions, if it's producing, if it's forested property that's producing an income, and even if it's only breaking even, as long as you have positive cash flow on it, that's fine, because probably over time it's going to appreciate. But to just go out and buy raw land and not have a good plan for it, and to finance that with debt, I'd be very skeptical. And again, I know guys like loss of names here, Mark Shepard. Mark Shepard's a big proponent of kind of buying things on debt. And again, no, I'm not a debt hater. I'm not like Dave Ramsey. I think if you use debt wisely, that's fine. But at the same time, for every Mark Shepard, there's a million guys or 1,000 guys that didn't make it. And just bad luck. You have a couple years of too much rain or not enough rain, or you break your leg, or whatever. You miss a couple mortgage payments and you lose the property.
What I look at and look for in property is buy from owner, and can I afford it with cash? And does it have a well? Like those are my three things.
You need water. You need water. You need absolutely. If you can get owner financing kind of things, that's the way to do it. But to go out and I this kind of conversation I'll have frequently, particularly if I'm at a permaculture or TSP type of event. I'll meet a nice young couple or a nice young guy, and he'll say, "Hey, I'm making $80,000. I'm a carpenter. I'm making $80,000. I've got $100,000 saved up. I want to go out and buy this piece of land in the middle of wherever, right, middle of nowhere, and I want to start growing fruit trees or whatever." And it's like, well, have you ever grown fruit trees? Have you ever grown land? And they've never done any of these things. And while they may be able to make it happen, I encourage them not to quit their day job. Hey, you're making $80,000 or $70,000 as a carpenter or electrician or mechanic or engineer or whatever it is. And just because you have $100,000 saved up doesn't, that's not going to last. What's it costing you to live? You're spending $60,000 to live. So really, you only have less than a 2-year income saved up. And if you go put it all on your property, and if you're in the middle of nowhere, you're not going to probably be able to get that job that's paying $60,000, $80,000. And before long, even if the property's paid off, you may find out you have no income stream. And I caution people not to quit their day job. Be patient. Build gradually. I didn't build my wealth overnight. It took me, 15, 20 years. It took me 10 to 12 years once I knew what I was doing, right? It took me 25 years to get to that point. And so people should just be very, very, be cautious. Don't make big mistakes.
All right. Let's see. We're almost to an hour, so we're just going to do 2 more questions. If you would take the time with us, John, to just do 2 more.
Sure. Absolutely.
Let's see here. Andrew asks, is there a condition where you wouldn't need life insurance? As if your house is totally paid off and you don't have any other debt and you have several years' expenses saved.
Yeah. Life insurance. I only recommend people get term life insurance unless there's some, and this is for the average person. If you're someone that has $10 million and you're buying some type of a whole life policy to get around estate taxes, that's a whole different story, right? But most people aren't in that boat. So for most people that aren't worried about estate taxes, then I think all they should carry is the most affordable or cheapest type of term life insurance that they should buy. And cheapest, I mean, in terms of the cost of it, they should have enough to be adequately insured, right? If you have one kid, you need less. And I don't know what that number is for each individual, but let's say you have one child to support. Well, maybe you could get by with $100,000. But if you have 6 kids, you're going to need a whole lot more. So it depends on what your personal situation is. But in general, you probably want to have at least 10 times. You want to have coverage for about 10 times your annual salary. So if you're making $50,000, you should probably have $500,000 worth of term life insurance. And again, but it depends on, if you have no dependents, you need 0 life insurance. The only purpose for term life insurance is to provide for your dependents. And so if you have no dependents, you don't need life insurance. If you have adult kids, hey, they don't need a benefit when you die. They're on their own, right? Or if your spouse is able to take care of herself, if the house is paid for or whatever, then she does. There's no reason that you need. It's insurance in our society has gotten to the point where we have health insurance to take care of everything. You want birth control pills, you use health insurance. You get a cold, you have health insurance. Well, that's not what health insurance is for. When you get cancer, the insurance is for the things that you don't know you're going to get. You're likely to get a cold, or you're likely to have certain kind of other needs that you would just normally budget for. You shouldn't use insurance for that, but that's not the way our society works today. So a lot of people have a misunderstanding of what insurance is for, but life insurance is there only to protect your dependents and to get basically to provide, as my father did. My father died when I was 6 months old. He had a life insurance policy, which basically provided my mother enough money to get me raised. We didn't live in affluence, but my mother didn't have to go out and work 18 hours a day to support my brother and I, because my dad had left us with some life insurance, and our house was paid for. It made a huge difference in our life.
I just do enough life insurance to cover my funeral and disposing of my body, basically, because I don't want someone to have to take on that burden. Other than that, I want to make sure that you're set up where you can survive on your own before I die, hopefully, then have to rely on my death.
Yeah, so like in my case, I had my wife and I had 6 kids. My wife, she had a career until we got married, had our first child. She stopped working, and then over the next decade, we had 6 kids. So I always carried enough life insurance to, as much as I could afford, to make sure that she could kind of raise those kids till they were 18 years old without having to work, and that our house would be paid for. And it wasn't always easy to do that. It's like I had to make a decision. I want to pay a higher life insurance premium, then maybe I could go buy a boat or something, right? But I had the life insurance, but I thought I owed that to my wife, because she'd given up her career and she'd married me, which was not a good decision, right? So, but I didn't want to leave her with 6 kids and destitute. I just didn't think, for me, that we talk about ethics and things. That was my responsibility, was that she needed to, if I died, that these kids should be taken care of. But again, they weren't going to be driving BMWs to a private school. There was just enough money that she could raise them and put food on the table and keep them fed and clothed until they were 18. So that was my goal. But yeah, you don't if you don't have dependents, you don't need it.
All right, guys. Let's see. Last question is from Carl, and he asks, "What podcasts, books, or videos do you recommend or listen to yourself?"
Okay, so shameless plug. I have to put in my a hit from my own podcast, the Wealthsteading podcast. That's there's not a mistake that's a takeoff of homesteading. It's wealthsteading. So I talk not only about investing in the stock market. So, for example, whenever I make trades in the stock market, I actually talk about that on my podcast. But I also talk about wealth building principles and things that we've been talking about today, how to get out of debt. So it's kind of all encompassing. I'd encourage them to start there. I'm very much a cynic on the financial industry overall, so there's not a whole lot that I pay attention to. Again, I tend to be a contrarian, and that's how I made my money over the years, by investing in the stock market, by doing what they told you not to do. So when everybody else was in .com bubble in 2000, I wasn't invested in that. And it wasn't that I always made brilliant mistakes, because I'll tell you, in 2000, I owned Boston Market. One of the stocks I owned was Boston Market, which went bankrupt. That was a lousy investment. So it wasn't that I always made good decisions, but I didn't do what everybody else was doing. So when the .com bubble fell apart in 2000, I had cash to go in and buy the market. In 2008, I lost maybe 18%. The market was down 48%. So again, when the market fell apart, I had money in 2009 to go in and buy stuff that was really cheap on sale. So you don't hear a lot of recommendations and advice like that, though, to be patient, to not invest until you have $50,000 or $100,000. You're mostly going to get investment advice where people are telling you how to turn $500 into $10,000, or how to flip real estate. And so I'm really skeptical. I obviously listen to the Survival Podcast. I think Jack Spirko gives a lot of good advice. If you're interested in starting a business, I think you should listen to 5 Minutes with Jack, his old podcast. I do listen to CNBC. I think it's the Fast Money podcast. I don't have time to watch it on TV, but I'd say probably the only real financial podcast I listen to on a consistent basis is Fast Money, and that just helps me get a perspective of what the establishment thinks. But if you listen to that and you try to make investment decisions, you go crazy, because they always have the bear guy and the bull guy, and one guy's telling you the market's going to 10,000, and the other guy's telling you no, it's going to zero, and one guy's telling you buy gold, the other guy's telling you no, sell it. So, I listen to it to just filter the noise, but I don't think you get good advice on any of those things. I think it's the same way our grandparents made money. You get a good job, or start a business, you save your money, and then you look for appreciating assets. You don't try and make money overnight. You buy good quality things. You buy good quality real estate. You buy good quality stocks, and that changes over time. But right now, good quality stocks are the things that would come to people's mind. Things on the good stocks in the Dow Jones Industrial Average or S&P 500. You dollar cost average into them. You don't buy when the market's at an all-time record high like we're at right now. And I just don't think you get a lot. And I don't filter other podcasts, so I don't know. Maybe there are other people preaching the same thing I'd say, but I haven't heard a lot of them. I mostly hear buy and hold or do some crazy investment strategy with stocks or Forex or options, and none of that works. People that invest in Forex and options, they're generally broke in 6 months. What's the best way to make $100,000? Right, start with $200,000, and they lose half of it.
Yeah. All right, guys. Thank you very much, John. A great amount of information and detail for us. There are a couple more questions, guys, but they're pretty advanced and specific. So we didn't get to those now. But if you want to get a hold of John, what's the best way to get a hold of you and ask those questions?
Yeah, so the best way to find me is I have my business, Investable Wealth, but the Wealth Setting podcast is really, you can go to that website. You can download that on all the normal places. You download the podcast. If you specifically want to get a message to me, just go to wealthsteading.com. That's the podcast website. And there's a contact form on there. Just leave me a question. If the listeners, and I get so many emails, I can't answer everybody normally, right? But I know people took the time to come here today. So if you put in somewhere in that message and tell me, hey, I was on the PermaEthos TV podcast thing or feed, this is my question, then I will do my best to specifically answer your question. But otherwise, I just get too many questions. I can't answer them personally, but I will make a definite effort to get to the people that we missed today. So go ahead and
yeah, I would say if you guys, if you could just put a PETV in the subject line.
Yeah, that's perfect. And then I'll do my best to answer your question personally.
Thank you.
And just by the way, too, so people know, I'm not a financial advisor. I specifically manage client portfolios. So I'm not someone that's going to try and hustle you to pay me $1,000 to answer your question or something. I don't provide investment advice. I give you my best thoughts that I have, my opinion, and encourage you to research it yourself and do the best you can.
Yeah, guys, and I've spent a long time with John and met him a couple times at least at the Survival Podcast at Jack's. He's a great guy. He's very honest, and otherwise I wouldn't have him on the show. Thank you very much for being with us today, John. It was very beneficial, lots of information, and I think everybody got a great deal out of it.
I appreciate it. Happy to do it again, Josiah. Take care now.
All right, guys. Next week we have Brandon Williams on the show. He's going to be talking about off-grid battery and solar systems. I hope you enjoyed the show, and we'll see you next week.